Thank you for joining today's webinar, Managing Your Agri Manager. My name is Jodie Rosé O'Brien, and I'm one of the AWI Extension South Australian team. And tonight is being co-hosted by my colleague from Livestock SA, Penny Kane. The webinar tonight is supported by the Australian Government's Future Drought Fund, the Government of South Australia, Livestock SA, the South Australian Drought Resilience Adoption and Innovation Hub, and Australian Wool Innovations AWI Extension South Australia. Tonight's webinar is being recorded and will be uploaded to the AWI Extension South Australia YouTube channel in the coming days, and we welcome you to revisit that or share it with others. Today's presenter is Chris Scheid from More Australia. Chris has been a business, management and agribusiness advisor for the past 25 years, with a passion for supporting farming families, family corporates and small and medium enterprises across South Australia and Victoria. He works to assist with solving problems, establishing good working systems, and identify and harness opportunities consistent with client goals. And he regularly provides strategic input with clients, as well as assisting with change management and adapting to industry change. As a non-executive chair of family businesses he works with, Chris also coordinates clients' professional advisor teams, often comprising accountants, financial planners, solicitors, and agribusiness managers in a family office. Chris also acts as a project manager and delivers farm management and other specialist training courses. At this time, I'll hand over to Chris. Thanks, Chris.
Thank you, Jodie. So, look, tonight I just wanted to point out a couple of things about perhaps managing your Agri Manager. I feel in the last 5 years in particular, banking's changed. And I feel that perhaps we haven't caught up with the changes, and there are some important changes for us to catch up with so that we can start managing our Agri Manager, because in many circumstances, they're not managing us. So some key points this evening are, I just want to outline, I reckon there's a new banking paradigm that we need to catch up on and what that is. When next we might be meeting with our bank manager, it might be an annual bank review. So how can we actually manage our Agri Manager if they're now not managing us? There's always the topic about negotiating interest rates and how we might do that successfully and talk the bank language. There's other lending options other than just straight banks, and some final thoughts. So that's the structure of our webinar tonight. I think there's a new banking relationship, and I think that's perhaps taken us a while to catch up with what that new banking relationship is. When I think about it, 5 years ago, or even maybe 5 or 10 years ago, everyone had a bank manager, whether you had $100,000 worth of debt, $1 million or $5 million of debt. Nowadays, you're probably lucky to have a face-to-face bank manager if you've got $2 million of debt, and some banks require $3 million of debt. For those of you with $1 million worth of debt or less, you might be dealing with a customer service officer or a call centre, or maybe a less senior or more junior bank manager. So that's changed, that banking relationship's changed. The other thing that I see that's changed is, just as we've found it difficult in agriculture to find and to retain staff, people for us to work with, the banks are no different. So when you look at the hierarchy of banking, your higher level bank managers, your senior bank managers, they're either retiring or they're leaving business. And I had a client today who's a bank manager who's decided after 27 years to leave the bank, and they're starting up their own brokering businesses. That leaves holes at the top. So the middle bank managers move up. Some of the middle bank managers as well, around this time of year, May, June, start to look at the other side of the fence, and there's a churn of bank managers from one to the next. Then we've got gaps in the middle. So undergraduates that come out of university then have to rise quickly into the middle ranks to fill the spaces that are left, that have been created by the middle. So there's a continuous and a churn of bank managers, and has been for probably the last, well, at least 3, 4, maybe 5 years. I've got one client who I quoted back in February who's had 5 bank managers in 4 years. Well, now he's had 6 bank managers in 4 years. So I think we should expect, just as it's difficult to find people in agriculture for us to work, I think we should expect for this to continue in banking. We should expect to have a churn of bank managers many times, and we should expect that perhaps the level of service with banks is only for those that have higher levels of debts. So the question then comes that if in the old days the banks used to manage the bank relationship, and if you've got bank managers turning over, who's managing the banking relationship? And if the banks aren't, it's really up to us. And there's two possibilities. Either you outsource it through a broker or a debt advisor, or you do it yourself. And tonight I want to talk about the do it yourself and how we might manage the bank manager and manage that relationship. Let's just look at the annual bank review, perhaps as one opportunity where we meet with the bank manager and what the reasons the bank manager might require and the bank might require that meeting with you. So specifically, there's two things. The bank wants some information, and I think there's an opportunity for us to get some information from the bank too, for us to manage our manager. So the bank typically at their annual bank review, they want to check on security. They know they've got security covered. They're just really interested to see what you think land values are versus what they think, because that's really an esoteric thing, the value of land. The market only knows that. They're there for point number 2 to check on debt serviceability. So with your cash flow budgets and your past taxation financials, have you been able to, with your taxation financials in the past, and are you able to in the future, with your cash flow budgets, meet debt requirement commitments, service interest, bank fees, and service principal, if there's any principal repayments in your loan documentation? If you can meet security requirements, which invariably you can, if you meet debt serviceability requirements, then banks simply are there to turn up for question number 3, do you want more money? They're the simple 3 bank metrics that banks are requesting at their annual review. I've got a question there about confirming your interest rate. Do banks actually ask you whether you like your interest rate? I don't know of many banks that do. I think that's really a question that we need to ask, and I'll go on a little bit later into the webinar into how we might ask that question and talk the bank language, so we can speak the bank language, and we can look at how we might negotiate interest rates. The annual bank review, is it an opportunity or a threat? There's a fellow who invented the Model T Ford called Henry Ford, and he had this great saying that I like. It says, whether you think you can or you think you can't, you're right. Whether you think you can or you think you can't, you're right. Now, what's that saying? To me, that's saying that it's about your attitude. That if we go into the bank review meeting thinking that it's going to be negative, then our tone, our language, our body language, etc., our whole disposition will be negative, and we'll reap the harvest that we sow. But if we go in on the other foot, in terms of it looking at it as an opportunity, open and transparent communication, asking questions to collect information, providing clear information, and providing honest feedback to the bank, then we'll harvest a better harvest. What are the opportunities? Because I don't really want to focus on what the threats are. The opportunities to me are that, first and foremost, your bank is your business partner. So just as we might be involved in our businesses in a partnership, or we have partners, spouse partners, we would never tell lies to our spouse or to our business partner. So surely we would never tell porky pies and lies to the bank. So because the bank own a bit of our business, 70% equity, they own 30% of our business, they're our business partner. And as business partners or spouse partners, we should be transparent, we should be talking the truth, and we should have open communication with the bank. Really, when you think about it, in agriculture, we live in small communities, bad news travels, and if there's some bad news about your business, the bank probably know anyway. So it's probably better for you to be open and transparent and to talk about that, and to paint the repair picture that I put down there a little bit later, paint the repair picture if it's not a positive thing, than to not paint the picture at all. Of course, if there's a positive picture for your business about some achievements you've achieved throughout the year, so the loan we got for the new piece of machinery, got the seeding in on time, yields were better, etc., and the truck that we got some money borrowed for enabled us to get harvest finished before the rains came. Paint the positive picture, as well as, if it's not a positive picture, paint the repair picture. And to me, the repair picture, just to harp on that one, to me, the repair picture that there's, to me, the repair picture there is about not only pointing out the problem, but pointing out the solution. Now, with sons and daughters and people that we employ in agriculture, don't we like those people that give us the problem, but also give us the solution? So let's manage our manager in the same way by providing them with the problem plus the solution that we've already come up with. And the bank's language of solutions is about numbers. The bank's language is about cash flow budget. Here's the problem. Harvest was $200,000 less than what it was last year. Here's our cash flow budget going forward, showing that the $50,000 that we were going to spend on this piece of capital equipment, we haven't decided to spend. We're still $150,000 behind. We'd like to talk to you about extending our working capital by $150,000. Paint the problem and the solution. I think with the other opportunity is to outline the successes with your bank review. It's an opportunity to request new funds if it's required. It's an opportunity to ask the question about an interest rate review. And it's also an opportunity to look at ensuring that your structures fit your cash flow. So an overdraft, for example, is a current liability. And by definition, a current liability must return back to zero, must be repaid in the year. So if you've had an overdraft or a seasonal account or a line of credit, for example, that's had to be repaid and you haven't repaid it during the year, it says to me that you've got a whole element of core debt that's sitting there at a higher interest rate, at an overdraft interest rate. Now, a good bank manager will point that out to you and take the core debt out of the overdraft and put that onto term debt at a lower interest rate. But a better farm manager will point that out to the bank about, this is what I would like you to do. This is how we can manage our bank. Let me come back to the interest rate review shortly. So what documentation do we need at our annual review? And very often, what documentation do we need if we're going for a loan for a new piece of machinery or even a new piece of land? First and foremost, we need a current set of taxation financials. So your 22s and your 23s completed. We haven't quite finished the 24 yet. Now, the reason why the bank needs that is because you've submitted your taxation financials to the tax office. And just as you wouldn't tell porky pies to your business partner in the bank, you would never tell porky pies and tell dishonest truths to the tax office. So the bank sees that your set of taxation financials are the version of the financial truth, the income and the expenditure for the financial year. The banks take your profit and loss, they add back depreciation, they take off a reasonable level of drawings and they call it your EBITDA. That's your profit. And with that, they use that and they turn that into some banking ratios to determine debt serviceability. The bank will often, particularly if you're looking for new loans for land or significant pieces of equipment, for example, they often want statements of position, which is balance sheets, assets and liabilities. And very often, and they'll request forecasts of cash flow. So again, they're using your cash flow forecast to determine serviceability of debt. Can you service the debt? Statement of position, security of your business, pass those two tests, loan approved. Now, they're the 1, 2, 3s that the banks will often ask for. But I think it's, in terms of managing your manager, I think it's good to also point out to your bank, what's your business plan? Or if you don't have a business plan, what's 5 or 6 dot points on our thoughts for the future? What's our plans for growth? Do we have school kids? Do we have children going to university or to boarding school at requirements coming up? Is there new machinery that's needed to be replaced? What are we looking in terms of purchasing a block of land? So point out what your growth plans are, what your future plans are, because it's a direct correlation there between what the bank thinks that lending opportunities might be coming up for you. And the final thing that I think is pertinent to provide to banks is an idea about what you see the key risks are to your business and what plans that you have to circumvent. Now, to me, it's no good just identifying what the risks are, because anyone can do that. After you've identified the risks, what are the key risks? What's the plan that you put in place to circumvent that risk? So, for example, if it's a dry spell, if it's a dry spell. So what will we do? Will we feed livestock or will we sell livestock? Have a hit list and sell livestock? What implications does a dry spell have for our people in our business, for our enterprises? How will we manage it so that we maintain equity in our business? So some dot points there about firstly, key risk, but then secondly, strategies about how I will circumvent or mitigate those risks are useful for the bank so that next year, should that risk occur and you've actually carried out that risk mitigation plan, you can report back to say, well, my risk mitigation plan for dry spell was to do X, Y, and Z, and we did X, Y, and Z. So the bank sees that you've identified risk, you've put a plan together, and thirdly, you've actually enacted the plan. Very quick notes on cash flow budget preparation. So months across the top, income down the side, and so income goes in the months, you know about that. Direct cost follows your income. So if we're sharing in July, if we've got wool income in July, then we might have sharing costs in July. If we're got selling grain in December, then we might have grain levies and freight costs in December. So your direct cost follows the production that you receive. Overhead costs, we can look at overhead costs from last year, add a bit for inflation, but think carefully about whether overhead costs have increased by only inflation. Insurance is one thing that's blown totally out of the water. Finance costs, it's probably a good idea if we're putting a cash flow budget together for the bank that we do include their interest and bank fees and principal if that's required. Capital cost refers to one-off costs of a capital nature. So we might be machinery repayments, or it might be cash we're using to purchase small plant and equipment. Drawings, don't starve drawings. So don't starve your business a cash surplus by starving yourself of drawings. The banks will simply add back a reasonable level of drawings. So you can't crimp there. If there's tax to pay, include tax, and if there's money to repay to debtors, include that. If at the end of the day we've still got a loss showing in our business, then if we can't change something in our budget going forward, then perhaps we need to think about lending and working capital requirements from our bank. Now, negotiating interest rates. I'm thinking about this in terms of, I reckon banks are experts at quantifying risk. What do I mean by that? What I mean by that is banks are experts at saying these are the risks that you have as a lender: drought, price, risk management, death of a key person, succession planning, and they're experts at putting a value on it. And the value they put on it is called your customer margin. So whatever you can do whatever you can do to identify risks, mitigate and prevent the risks occurring, and be less of a risk to the bank means you can have a conversation to lower interest rates. By definition, if you're lower risk to the bank, you could be and should be rewarded in terms of a lower customer margin. Other ways of negotiating interest rates are by outsourcing it through a broker. Now, the broker is paid by the bank. The question is ultimately whether the bank claws back the broker's margin and you're back to square zero. But a good broker will then come back to you and assist you to make sure there's not the clawback of that margin. Another new sort of service that's out there is a debt advisor, and a debt advisor is a fee for service. So they're working directly for you to provide a service for a defined fee. So the do-it-yourself is really about time and skill and negotiation. And I want to outline to you how I work with clients in terms of an annual general meeting to help navigate and assist clients with negotiating interest rates. So here's a little picture I put together, and here's some key people around our family board. So I've got myself there with a lot more grey hair than I normally used to have as chair of the family board. I've got the client, I've got the bank manager, and I've got the accountant. So typically I'd have an annual general meeting with clients like that, and I'd have all the advisors around the table just for a half a day. I'd ask the client to outline successes, risks they see in the business, future plans. I'd ask the accountant to provide an idea about the set of accounts, the taxation position, what we're doing to minimise tax, how they see the business. I'll provide a review of the business in terms of strategy, things we're working on, projects, etc. And then I'll ask the bank to table what they see or how they see the business going in terms of debt serviceability, in terms of the 5 Cs of banking that I'll come to in a minute. And I'll also ask finally the bank manager the question, if this business is to be less of risk to you next year, what are the key risks it needs to work on this year? What are the key risks that this business needs to work on for this next year? And in a transparent conversation, the banks are more than happy to say that it's succession planning, or there's a key risk person here. We need to solve that issue, or there's succession planning, or some price risk management, or drought management because where you're located, etc. But when I'm hearing those risks identified, that's my agenda in working with the client for the next year. In the bank's identified the risk, but putting a plan together to mitigate the risks, so that next year we can report to the bank at the annual general meeting that we did put in place a plan to minimise drought, that we did work key person risk, that we have started on succession planning, etc. And in working and lowering risk to the bank, we can now have a conversation about lowering interest rates, our interest rates, our customer margin. And true story, it was a year ago at a client meeting where a client had $7 million worth of debt. I asked the bank manager, what does this business need to do to be a lower risk to you? What risks do you see that we need to work on so that we're less of a risk for you next year? And the bank said nothing. $7 million worth of debt, there was no risk. So we'd covered off on all the risks that the bank could see. And the very next week, we spoke to the bank and we negotiated 0.1% off 7 million, which is $7,000 saving in interest, which is that year and every year after that. So it's a recurrent interest rate saving. So it can work by talking the language of banks, which is risk, getting them to identify the risks that they see that we need to work on, and then working on the risks, we can navigate and get lower interest rates. Probably covered a bit of that. So our interest rates that we pay is your base rate and your customer margin. We can't do anything about the base rate. Your customer margin is defined by your management of risk that I've just covered, and the 5 Cs of lending. And very quickly, the 5 Cs of lending: capacity, so ability to repay, covered that. So if the bank says, look, we really do need to see a debt service coverage ratio, a finance coverage, or an interest coverage better, so there's some work that we can do there to repair that. Character is another C. So character talks about reputation and your financial behaviour. Character's often yes or no. Either you've got good character, yes, and there's nothing more you can do to improve, or you don't have good character, and it's very difficult to repair a poor character. So examples of poor character may be if you continue to provide budgets to the bank that are way outside of what can be achieved and what you ever achieve, they may question your ability as a manager and your character may come into question. In the olden days, I used to talk about character in terms of passing bad checks, but no one knows what checks are nowadays. So character is often a yes, no. You've either got good character or you don't. If you don't have good character, it can mean from some banks that you're just not able to get a loan. Capital talks about your skin in your game. So really that's your equity. If you've got 70% of the business you own, well, then you've got 70% of the skin in the game. Collateral talks about the security offered. And the question here is to the bank, if I offer more security, will it help me with my interest rate? It doesn't always, but it's a worthwhile question. And the final C is conditions. So there are so conditions talk about the enterprise that you're in, the economic circumstance, or perhaps some banks are just looking at market share in a particular area of lending at the moment. And the real life example at the moment is we're working with a client in Western Australia who I worked with many years ago, and he came to me Christmas time. He's a sheep grazier down in southern Western Australia, and his bank, so the sheep industry, poor sheep industry in Western Australia with the live sheep trade exiting, this bank's decided to exit the sheep lending to sheep producers, and this client had land that was unencumbered and was unable to get a $300,000 extension to their credit facility. So effectively, the bank said, "Look, we don't. The conditions for sheep enterprises aren't good. We wish to exit that enterprise. Possibly covered off on this. So here's just an example about some risks that we might consider. We might ask the bank for them to assess which risks we need to cover off, and then put in place a little policy, like a plan to mitigate production risk, a plan to mitigate price risk or climate risk, or death, disability, divorce, disablement, depression, some of the 7Ds. So identifying the risk, get the bank to identify the risk, put the plan in place on paper, and then report next year to the bank. Well, yes, look, I did improve my production risk management. I did improve my price risk management. Right? I have looked at a key person risk in terms of death, and we have started succession planning. So we're now a lower risk to you, Mr. Bank Manager, Mrs. Bank Manager. Can we talk about an interest rate reduction or interest rate review? Last couple of slides, other lending options. These are becoming, so Regional Investment Corporation or RIC loans are becoming increasingly popular. I don't have the figures, but I think it's billions of dollars that the Future Fund has lent to farmers and graziers throughout Australia. There's 3 different Regional Investment Corporation loans: Drought, Agri-Starter and Farm Investment. Each of those loans, you can get a loan for up to $2 million at 4.99%, interest only for 5 years. You need to have at least 50% of your loan or more with your existing bank. So if you've got $4 million of total loans, $2 million can go to RIC, $2 million to your bank. If you've got $5 million of total loans, only $2 million can go to the Regional Investment Corporation loan. They do take a little bit of emphasis and time to put together. The client I was with today, we're looking at a 7% margin, so 2%. So $2 million at 2% differential is $40,000 a year. 40,000 times 5 years, $200,000. So if it takes 2 days to put it together, it's $100,000 a day work. If you can get better return on investment for your day's work, then go and do that work. But if not, you might like to consider looking up Regional Investment Corporation loan and seeing if you qualify for that. There's another smaller loan called an AgBiz drought loan, where it's for drought mitigating, not for drought mitigating circumstances. So stock containment area, for example, or a feedlot or silos, for example, where you can lend up to $500,000 again at 4.99%, 5 years interest only. I think other lending options, mortgage broker and debt advisory service, I've discussed a little bit, and many would be aware of that. The other one I come across, and I did come across last Monday with a client, private and family loans. I think it's really important that these loans are written loans. So I think so. Last Monday, wife had lent the husband some money, put back into the business. We sat down and navigated and negotiated an interest rate somewhere below the bank interest rate, but somewhere above the deposit rate. So there was a little bit of a pain point for the interest rate. We discussed and we wrote down the terms, the repayment, and we basically wrote and got a written agreement so that in that circumstance, husband and wife could remain in business separate to being husbands and wives. So I think written agreements, particularly if families are involved in loans, is a really important thing to do to keep business as business and family as family. The other part about written agreements and family loans is if they're unwritten, it's amazing how one party has a preponderance to forget about what the amount was when it was due to be repaid, and what the interest rate was, etc. So a written loan prevents that. Other support, just a word of caution here. So I'm a farm business consultant, agronomist as well. Livestock professionals might also be helping you out in putting together cash flow budgets. We're not allowed to provide financial advice, and financial advice can be as simply saying, well, I think you should consider fixing this amount of percentage of loans as fixed and this amount as variable. So that's construed to be financial advice. Deferring costs into the new financial year, etc., that's construed to be financial advice. So business consultants, agronomists, livestock, it's financial advice. We shouldn't be providing that. And you should take caution if you're receiving financial advice from someone who's not authorised to. The family and business support, the FABS mentors, are a great they're a great service to help navigate. So if you're not sure of an advisor or someone to help and assist you in your journey in terms of negotiating interest rates or banking or lending, for example, they're a great place to start, and they can take you to the place that can help and assist you. Rural business support, website address and phone numbers there. Rural business support not only help businesses that need in critical support, but they also help businesses that are just struggling to find some help and assistance as well. So they have some great people at Rural Business Support to help out. I just finally point out that the banks, when there's an obligated bank mediation service nowadays. When I was first in the advising game in the 1990s, banks were selling up farm businesses. And that just doesn't happen nowadays. And it doesn't happen nowadays because there's great corporate shame for banks if they're seen to be selling up overtly farms and farm businesses. So um, there's an obligated mediation service where the two parties need to get together. There might rural business support might be involved in that, and there's some opportunities for forgiveness of debt, um, and help and assistance for that person in crisis to be able to get away and not go bankrupt, for example, and forgive debt. So there's a bank mediation service that's obligated nowadays. Look, just in summary, I think there's a new banking paradigm. I think it's got past us, and I think we've missed it. Um, I think some of the circumstances, such as the turnover of bank managers and the fact that you've got to have a bit of debt nowadays to have a face-to-face banking relationship, perhaps has passed us. Um, if we're turning over bank managers, then the question I'm asking is who's managing the who's managing the banking relationship. I think the opportunity is for us to manage the banking relationship. So I think we can take control. And just as we might manage staff, I think managing the bank manager is something that is perhaps our responsibility if we don't decide that a debt advisor or a broker is to do that for me. The bank annual review is an opportunity and threat. I'm a bit of a glass half full person. I think it's an opportunity for an open, transparent conversation. It's an opportunity for us to ask the bank what risks do they see that we need to improve on so that next year we can come back and have a conversation about interest rates. That's how I negotiate interest rates. I talk the language about the bank, which is about risk, and I ask the question, what do we need to do next year to be a better position risk-wise for you? And there's support available in terms of paid support and also unpaid support that we just discussed then. I think that's my presentation, Jody. So happy to open the floor to questions if there are any.
Yeah, thanks, Chris. We've got a few questions that have come in by the audience. First one is, this person doesn't have an assigned agribusiness manager. How do they best negotiate with their bank for interest rate reductions, etc., and getting a better relationship?
Well, to me, the interest rate reduction one is, if you don't have an agri manager, it's very difficult to find out what risks that the bank sees for you. That's the first thing. We've got to actually find someone you can talk to that can assess your loan or assess assess your business to sort of see what risks that you might have. I'd be finding that person, asking them what risks they see, and then setting about on a course of mitigating, preventing the risks, and then presenting back and then navigating a lower interest rate. The other way that I'd look at too is the regional investment corporation loans. So 4.9, there's no banks supplying commercial lending at levels below 4.99%. So a couple of days hard graft, a little bit of hard graft in the office on a rainy day when it does rain is an opportunity to negotiate and get some lower interest rates, at least on 2 million.
Thank you. Penny, you had a question come in to you.
Yeah, thank you. And thanks, Chris. That was excellent. How long is it taking people to get finances for overdrafts, etc., at the moment?
Too long. It's really disappointing. Look, I'm working with a couple of clients at the moment. We're up to 14 weeks. One's for a simple overdraft extension, 255,000 to go from 745 to a million. Now that sounds like a lot of money, but there's $16 million worth of security. And the bank manager had a past approval at the bank desk of $10 million. So he could approve a $10 million loan and he's unable to approve a $1 million loan. I think some of the reasons for this goes back to the 2019 Royal Commission on Banking, where the banks got wrapped over the knuckles, and rightly so in many circumstances. And now the banks are very much more careful in following their own bank rules that they lodge with APRA, because APRA are checking them to make sure that they're dotting the I's and crossing the T's. So it's taking a long time. It's taking at least twice the length of time that it normally took. So if you're looking for a loan in the next month, you should have started 2 months ago.
Some great advice there, Chris. Another one here is lots of great information presented here tonight in the webinar. What do we, when I can find some time, this is from the person with their spouse, where do we start with our banking review, or like with what you presented tonight? What are the first 3 things we should do?
Well, I think if you don't know if you need money, you need to put the cash flow budget together to know whether you need money. If you do know that you need money and you need it last week, or you need it in the next couple of months, you need to work very quickly with your bank so that you can shore up your position. If you've already done your cash flow budget, and if you're fine within funds, so you can maintain funding for the year, I'd be inviting the bank manager to a meeting, and I'd be asking the bank what risks they see there are in my business, so that you can identify the risk, then put plans in place to mitigate the risk, so that next year you can come back and we can have a conversation about lowering our customer margin.
Great, some great first steps there for that attendee. Penny, you've got another question coming to you?
Well, there's actually been some questions come through in the Zoom, so we might answer them and then we'll go from there. So the first one, you seem to be focused on established businesses, Chris. How do people negotiate a loan without a huge equity behind them to build their farming businesses?
Yeah, so I think we're really talking here about cash flow lending. I think there are some banks that are willing to take. It may be a question of shopping around for banks, and it may be sort of non-conventional banks that we might be looking at. It might be sort of the Suncorps, the Judos, some of the different banks that might be willing to take a risk. Really, we're talking about cash flow lending there. So your cash flow needs to be strong. You need to be able to identify some common debt servicing metrics. So EBIT over interest needs to be times 2 times. And finance ratio, let's say of 15%. So interest as a percentage of income less than 15%, very broadly. So if your cash flow budget sort of shows that to a year in, year out, there's a stronger likelihood of being able to get a loan as a startup. But still, I don't have an answer for the security question. So there's a question about security. So what security can be offered if you're unable to pay the loan? Now, Tuesday, working with a client, and I did ask the question of the debt advisor, and the debt advisor in our business said, well, yes, we can get money, $300,000 or $400,000 in about 4 or 5 days' time, unsecured lending, but it's 16 and 17%. So unsecured lending, without security, we're looking at a much higher interest rate. I hope that helped that person.
Excellent. Another question here, Chris. This attendee has a RIC loan and the bank has treated us very poorly since, as in their words, you are a hardship case if you're with RIC. How do we manage that narrative? You've got some words of advice there.
Well, that's disappointing to hear. My client experiences with navigating RIC loans is the banks probably publicly have supported it. Privately, I don't know what they've sort of said. I think it's an opportunity to turn that relationship around and perhaps to demonstrate to your bank manager now how you're not in the circumstances that they see. And I guess if they can't see or won't see that you are doing a good job, if you are doing a good job, then there's always other banks.
Great advice there. I might just remind people, Chris talked about the 5 Cs. There is an article on the Sheep Connect website that outlines the 5 Cs in a bit more detail. And yeah, I think we'll leave it there. So thank you everyone who joined today's webinar. Chris, I would like to thank you for sharing your insight and expertise with us. If anyone has got additional questions, you can contact me directly. I want to again thank the funders for tonight's webinar, the Australian Government's Future Drought Fund, the Government of South Australia, Livestock SA, South Australian Drought Resilience Adoption and Innovation Hub, and Australian Wool Innovations AWI Extension South Australia. I thank you for your time. Have a lovely evening.